Okay, good morning, everybody. I apologize for the late start once again. For whatever reason, I don't know why this setup is different here than any other attend anywhere course I've ever taught. I've been doing it for a while, but I had to bring the tech guys over here to kind of figure it out. But nonetheless, whatever I don't get done today, I will, pick up and record for all of you. Most people are watching this asynchronously anyway. So anyway. Where we are today is we're talking about chapter 2. We're going to finish up chapter 2, hopefully today, and talk about what is remaining of this. And notice that I brought the syllabus here, and I pushed the due dates back for weeks 2, 3, 4, and so I highlighted some of these differences here, and you can see those in the Connect system if you're working on those. But for chapter 2, homework, quiz, bonus, those are due on this week, not the previous week. And the same goes week 3 and week 4. Now, and the one thing I mentioned before was the idea that the chapter 4 material is going to fall during the week of the due date, that is going to fall during the week of the first exam. So, make yourself, pace yourself, get a good sort of, time management system going on there, because it is going to sort of fall during that period. Okay, so today what we're going to do is we're going to finish up chapter 2 and talk about what's going on with chapter 2, and really it's sort of an introductory piece that we're going to cover here, and when we finish that, we're going to move into chapter 3. So we lost a bit of time here, and I apologize. I really do. The setup here is a little bit different, and I don't know why it's different, but it really is. I've been doing Attend Anywhere for quite a while, but for whatever reason, we seem to have these weird sort of visualizations, and I think the setup was wrong from the very beginning, but that's not my area of expertise. So I think where we left off last time was we were talking about trial balances. Now, trial balances in general are this idea of trying to balance debits and credits. That is, every entry in an accounting system has to have at least one debit, at least one credit, and it could be more or less on one side or the other, but the dollar figures have to balance at each time. So we do a series of trial balances, and one is an unadjusted trial balance, and that is at the end of an accounting period, whether it's a month or a quarter or whatever it is, we're going to end up with some sort of and I'll go back here a bit. Some sort of balance between debits and credits. Okay, the debits, and again, debits and credits really don't mean anything in their own right. They just simply are what they are. Okay, so here's an unadjusted trial balance, and we have the balance of debits and credits equal each other, and so that's good. But what about the adjusting entries? Now, when we talk about adjusting entries, this is really, I think, probably one of the big features of this particular chapter, and that's the idea that we're trying to match up and to adjust these accounts that are in need of maintenance. And so I think adjusted entries are this idea of trying to bring things current. And we have really two categories of account types that need to be adjusted for. Those accruals and deferrals. Deferrals, which I think your text refers more to prepaids, but sort of links back to the sort of original definition of deferrals, and that is deferrals being prepaid items where the activity follows later. The money comes first, the activity follows later. Accruals, just the opposite, where the activities come first and the cash flows later. But all of these have to be adjusted, and there are other things as well that need to be adjusted, things like depreciation. We're bringing things current because, property, plant, and equipment are depreciating, and so we have to depreciate those to write down the value of those assets based upon some assumed depreciation schedule, right? Also, other things that need to be sort of adjusted are things like estimates, and your text talks a bit about this idea of estimates having to be changed, particularly things like bad debt expense and how the enterprise's accounts receivable are performing. And that is, are we getting a better performance in terms of repayment or a worse performance? And so that will influence bad debt expense for the particular period. So all these are adjustments, but the key thing here is to arrive at a trial balance. And so this is where we left off last time. We were talking about the preparation of statements. In this order, this is the very last thing we talked about last Thursday, which is the idea that we do these things in order. Income statement first, statement of comprehensive income, which is sort of an adjunct to the income statement, because we know that in financial accounting, the big four statements are income statement, balance sheet, statement of cash flows, statement of shareholders' equity. And the big two, without any question, are the income statement and balance sheet. But they do different things. But what is this weird little fellow here, comprehensive income? And we'll talk a bit about that, because it's a way of sort of encapsulating activities that are really not operating, and they're really sort of tangential to what we're doing, but we nonetheless have to capture them. And so businesses will often report these as a separate statement. And I'll give an example here. If not today, then certainly as we go forward. And what I do, I'll get done today, because we lost about 35 minutes with the rigmarole of the Zoom system. I'll record whatever a bit later, and I'll show you some examples of what that looks like in terms of statement of comprehensive income and what that means. So let's talk a bit about the income statement and what it is. All right, the income statement is a change statement, and that really is. Remember, one of the metaphors that have been used for a very long time in financial accounting is the idea that the income statement is a motion picture that starts at some date and ends at some date, and we have all these activities that are going on: selling goods, incurring cost of those goods, earning a gross profit, and then having all these other non-product expenses, things like salaries and supplies and rent and all that. And as a result, we have a total operating income. And in 2110, if you took it here, we would always sort of separate the balance sheet or the income statement into three pieces. This part here, sales minus cost of goods sold and gross profit, operating expenses to get to operating profit, and then everything else, which is non-operating items, things like interest, revenue, or expense, whatever the case might be, and it gives us a net income figure. And I'm a tax person, so one of the things that I would really wish that we would talk more about in this class is the idea of income tax expense, but it's not here. But when we talk about net income in most of the financial world, when they focus on net income, we're usually talking about an after-tax figure. In this case, tax is not an issue, and so we're sort of cutting this out for the picture. But nonetheless, that's really the division of activities here. It's a motion picture that starts January 1st, ends December 31st, or whatever the year end is. And there are a lot of companies that have very odd year ends, but it makes sense to them if it doesn't make sense to anyone else. And so that's really what the income statement is, a very important statement. And let me get to the statement of comprehensive income and what we call the issue of OCI, other comprehensive income. And what we're talking about here, these are things that are outside of the normal business activity of the firm itself. It's not only that they're not a result of a transaction with owners, they're not maybe a transaction with anybody, other than the fact that they represent inflows or outflows. Now, I kind of like the idea, and I kind of come from an economics background originally, the idea of inflows and outflows, that is revenues and other inflows and expenses and other outflows. And one of those may be the big one, which is essentially the issue of currency translation, currency valuation adjustments. Comprehensive income is really a catch-all that really relates to activities that are outside of the company's normal scope of business, but nonetheless have to be accounted for because they represent inflows or outflows. And in this case, there will be two ways of reporting them. And I'll give you an example here in a second. One is a continuous statement of comprehensive income, or two separate but consecutive statements, which I think is probably the most common, where the income statement is followed immediately by a statement of comprehensive income. And comprehensive income, the two biggies here, I think, for the most part, are currency issues, particularly since a lot of the companies that we study in college accounting are international companies. They have global presence, and they deal in different currencies. And currencies fluctuate. Currencies are a commodity in their own right. So the euro fluctuates against the dollar, and the yen against the yuan. I mean, all these are floating issues. And so as a result, we have different valuations that result from that. The other one, which I don't think we get into in this course here, but in intermediate 2, we talk more about pension valuations, and those are also part of OCI as well. But OCI is not related really to the normal activities of the business, but are rather sort of tangential, but important. Okay. All right. So we talked about the income statement. Let's go to the balance sheet. So hopefully a lot of this is sort of review in a lot of ways. And we talked about the balance sheet. Unlike the income statement, where the income statement is sort of a motion picture where we sort of go from January the 1st to 12/31 or whatever, the balance sheet is a snapshot in time where we talk about the assets, liabilities, and shareholders' equity, which, by the way, feeds back into this notion of the accounting equation: assets equals liabilities plus shareholders' equity. In other words, assets, which everything is owned or controlled, equals liabilities, that is the creditor's interest in those assets, and the shareholder's interest in those assets. And so, as a result, it sort of relates back to the original accounting equation itself. Okay. And here we talked, and hopefully this is a bit of a review, we talked about current assets and current liabilities. So obviously different sides of the balance sheet. Current assets are those assets which are going to be used up within a year or the operating cycle, whichever is longer. Now, there's a great discussion in the text about this operating cycle and whatever it is. So for most businesses, and I don't know the ratio, honestly, but I would say for most businesses, the operating cycle is well less than a year. It's simply the cash-to-cash cycle. We have cash, we buy inventory, or we buy supplies, we do something, we provide a service or a product to a customer, and we collect and we get cash back, and it's usually well within a year. But there are entities that go well within a year, well, longer than a year, if you're building a casino or a submarine or a hotel or whatever. I mean, some of these cycles are much longer, and so as a result, the current period here needs to really be understood as the operating cycle or 1 year, whichever is longer. Okay. And that's what really current is. And the same issue really applies to liabilities as well. Okay. It's the operating cycle. Most businesses, and I mentioned a minute ago, I really honestly don't know what the percentage of businesses are, but I would imagine most of them are well within a year. And so a year really is the sort of delineating factor here as to what's current, what's long term. So when we talk about things like liabilities, for instance, it's probably a bigger issue with liabilities. That is, what's due within the year or less, what's due longer than a year. And current assets, when we talk about current assets, cash obviously is the most important piece, and it's always the top line on the left side of the balance sheet in terms of what is the most current asset. We'll talk a bit about cash here in just a second. Okay. All right, so non-current assets are those assets which will have a life that is longer than a year. And we're talking about things like property and equipment. Sometimes we sort of link these into a category called PP&E, property, plant, equipment. It's long-term assets, and they're sometimes called fixed assets. The term fixed doesn't mean they're fixed in place. An 18-wheeler is certainly not fixed in place. Neither is a 737, but they're fixed on a balance sheet for a period of time. They're non-current assets. They have a relatively long life, certainly over the operating cycle. Also, things like long-term receivables, long-term investments, and we'll talk a bit more about investments a bit later, and how this is a different issue than short-term investments, and how some short-term investments can actually be classified as almost like cash in some ways. Long-term liabilities, all those liabilities are not included and classified as current. And here, there's not a lot of ambiguity here, I don't believe, in the sense that a lot of companies have long-term debt or mortgage debt or bond debt that's a very long-term nature. So this is not really subject to a lot of debate in some cases, but long-term liabilities are those things which are liabilities to the company. So they have a credit balance on the right side of the balance sheet and will be retired over time. And then shareholders' equity, which is really divided into two pieces. Paid-in capital, which is not generated from operating activities, but from initial issuance of primarily stock, right? well, stock, not primarily stock, as well as any kind of additional paid-in capital. Sometimes companies buy back stock, resell it again. All that's considered paid-in capital. And companies will sometimes have an authorized number of shares, but not issue all those shares. And sometimes the amount paid in exceeds the initial price, and so that we call additional paid-in capital. That's subsequent to the initial value. So paid-in capital is one form, and then also what we call earned capital, which is primarily income, which is capitalized. That is income that's not distributed to whom? Shareholders, and also not taxed away. And so retained earnings are a great thing to a lot of companies, and they're not taxed away, not dividended away, and also sort of retained as well as in terms of retained earnings. And a lot of companies don't pay dividends at all. It's not like dividends are not a thing in the past at all, but some companies don't pay dividends because they prefer to retain earnings in order to grow the business itself. And so that's a very common thing, particularly in technology firms and those companies that are fast growing. And their shareholders are okay with it because the fact that it continues to grow the share price and all of the good things that come from that. Okay. All right, so here's a balance sheet example. We're back to our dress-like clothing example. And I know these slides that I'm projecting here are maybe a little bit small to see. I'll try to blow them as well as I can. But what's going on here is this. So this is a very generic balance sheet. Oops, what did I just do here? Oh, did I get rid of it? Hold on, I'll get it back. There we go. So, all right, so let's talk about this. And let's sort of do the autopsy on the balance sheet here. So as of July 31st. So we don't know if this is a quarter end, year end. It doesn't matter. A company could do a monthly statement if they want to do it. Public companies really have to report on a quarterly and annual basis, but we don't know what this is, but it doesn't matter. So we have current assets, cash, receivables, and inventory. Those are really the big three: cash, accounts receivable, and inventory. And you may have some other issues like supplies and whatnot, prepaid rent, or any kind of prepaid insurance, whatever the case might be. So we categorize those and we sort of subtotal up our current assets. And then we have property, plant, and equipment. We only have one major category, office equipment. With accumulated depreciation, that's the contra asset account. It reduces this over time. So we have total assets of $143,500, and current liabilities, things like payables, like accounts payable. These are trade payables, salaries, deferred revenue. Remember, deferred revenue is one of those deferrals, which is where somebody pays us ahead of time to do something, and we haven't delivered the product yet. So, advanced ticket sales, or a prepayment of whatever it is we're doing. Subscriptions are a good example of deferred revenue. In this case, it's rent revenue, but it's whatever the example might be. And the dollar figures are really small. I get that. And let's not get distracted by the dollar figures. Let's more focus on the relationships and how things sort of fit together here. And then interest payable, which is obviously on some obligation. So we have current liabilities, right? And we can compare current assets to current liabilities. And it looks like we have a pretty good coverage there, even though a lot of public companies today have a very sparse current ratio, which used to be a big deal back in the day. Not so much anymore, but you kind of get the idea. It's a thing. And then we have long-term liabilities, notes payable of $30,000. And then we go to the shareholders' equity section. Common stock, 6,000 shares issued and outstanding. Looks like $1 par value, and par value itself is sort of meaningless and sort of arbitrary. But retained earnings oftentimes is a big value. We're retaining earnings from the earnings of the company. So shareholders equity is 61,917. So if we add this and this and this, we get 143.5, which equals the asset side of the balance sheet. The balance sheet has to balance. If it doesn't balance, it's not really a balance sheet. So I hate to be flip about it, but they've got to sort of match up with one another. So that's the example of the Dress Right company. Hopefully, a lot of this is a review that we talked about in previous sections, and then certainly as we get into chapter 3, we'll get a lot more review of things which you probably covered before, but it's good to kind of go over things once again to kind of make sure everyone's on the same page. Okay. All right, so we talked about the income statement, talked about the balance sheet. Now we're on to the statement of cash flows. And so this is, to me, one of the most mysterious and yet interesting of the statements. And that is the idea that talks about where money comes from and where it goes. And we divide these flows in and out of an organization based upon three categories: operating, investing, and financing. OIF, just kind of remember that: operating, investing, and financing. And what are we really getting at here? Well, let's kind of tear into this. And this is not the last time we'll talk about the cash flow statement. If not in this course, certainly in intermediate two. Operating activities, I think we tend to think more about income statement activities. We sell goods, we post a receivable, we collect the cash. Now remember, we're talking about cash as cash here. We're not talking about the value of inventory as cash or the value of equipment as cash. We're talking about actual cash itself. Okay, so operating means we're selling stuff, we're collecting receivables, we're paying invoices, we're doing all these things, and it's money in, money out. That's really essentially on a day-to-day basis, and that's really, I think, more associated with income statement activities. The last two, investing and financing, refer to both the left and right side of the balance sheet. And then as investing activities, we're talking about involving, so investing, we're talking about buying or selling long-term assets like inventory, equipment, real estate, land, whatever the case might be, or divesting ourselves of it. And so investing is not financial investment, stocks, bonds, or whatever. That's not really what's going on here. I mean, it could be, but that's not really what's happening. It's more about the idea of long-term assets and some things which are held for investment. A lot of companies have assets which are sort of carried over from acquisitions, and they don't really fit into the way the company's doing business now. So they might want to divest themselves of them. And so as a result, they would fit into investing activities if the cash flows in from that. And then finally, financing activities, which goes to the right side of the balance sheet, where we're talking about liabilities that borrowed money and repaid money, and also raised capital from the equity side, stock transactions, stock redemptions, stock buybacks. And we'll talk a bit about that. So in some ways, and I'm oversimplifying this, but I think it's a useful way of thinking about how we construct the cash flow statement. More or less operating activities going to income statement activities, investing activities, left side of the balance sheet on the asset side, financing activities on the equities side, both involving liabilities as well as shareholders' equity. I think it's really sort of the way to sort of view these. And if you look at the cash flow statement, we certainly are in this course, we're talking about the idea of inflows and outflows. And at the end of the day, we've got to sort of reconcile where we started the accounting period with cash and where we ended up. And we should be able to trace all that, and that's all to the good. In a sense, we can figure out where all this money is going. Okay. All right. So here's an example, and I know it's a little bit hard to see, particularly if you're watching it on the video, but it's here in text. So here's an example of a cash flow statement where we have operating activities in the first category, OIF, operating activities, cash flow from customers, from rent or whatever. It doesn't really make any difference. So inflows, outflows, and so you have a net amount from the operating activities. We have a net amount from the investing activities, which is negative. All that really happened here was we bought some office equipment. And the financing activities, we issued stock, we borrowed money, so there's an increase in accounts payable. We paid dividends, and dividends are simply a reduction in the equity of the company, and so that brings down that portion of the balance sheet. So as a result, we get to $99,000 from this activity. So the net increase in cash should be $68,500, which should reconcile with the month, if it's a monthly statement, the month prior was cash that began the month $68,500 less. If it's not, we've got a problem we've got to figure out. Hopefully these should reconcile, okay? And that is, we're accounting for cash flow. Not cash in terms of wealth or market value, but cash as cash itself. So the cash flow statement is sort of an unsung hero, I think, in a lot of ways. And it really sort of tells where money comes from and where money goes. When I say money, I'm talking about cash itself. Okay? All right, so any questions about the statement of cash flows and what we're doing there? This is not the last time you will see the cash flow statement, particularly if you take intermediate 2. We sort of drill down into the cash flow statement and talk more about what we're doing and why we're doing it. But it really does tie in very nicely to a company's balance sheet as well as retained earnings in the sense of where the money is being generated. Okay. And if you like the term cash is king, then we are very interested in where cash comes from and where it's going. And then the final statement is statement of shareholders' equity. Now remember in chapter 2, what are we doing here? We're sort of doing a preview, an overview, hopefully an overview of what financial statements are in general. And statement of shareholders' equity is sometimes called statement of retained earnings. I'm old enough to remember when this used to be called statement of changes in shareholders' equity. I mean, there are all kinds of different names, but they really are the same thing. And that's the idea of how did ownership change during the year? A lot of it had to do with income that's earned and placed into retained earnings. And the dollar figures are very, very small, and so I understand that. But nonetheless, it talks about where the changes come from in shareholders' equity from the beginning of the period to the end, including things like investment planners, that's injections of capital, wherever it comes from, internal, external, doesn't really matter, right? Individuals, that is, distributions, that is mostly dividends or stock buybacks or whatever. Net income usually is a very significant piece. That is, companies are earning income, some of which is taxed away, some of which is expensed away, some of which is dividended away, some of which ends right back in retained earnings and becomes part of the capital structure of the company on the equity ownership side. And then other comprehensive income, which we talked about before, and that's the idea that some companies have either positive or, by the way, negative. And I think I'll show an example here of a company that has negative comprehensive income, which is simply the result of doing business and having to incur things which really are not operating. They're not necessarily income, expense, or revenue or expense items, but just are things. And so as a result, we have to kind of deal with those. Okay. All right. So any questions so far about anything we've talked about here? Okay. All right. Let's go down here a little bit and talk more about the shareholders' equity statement. I went too far, didn't I? Statement of shareholders' equity. Okay. All right, so we talked a bit about this idea of adjusting entries, and we're going to close accounts, and why we would do that, and why would we do that? We would do it because we're trying to close out a temporary situation, which is the operating environment, a year, quarter, whatever. A year sort of comes to mind, and we're trying to close out these temporary accounts. These are primarily income statement accounts, right? And we're going to zero them out. And how do we zero them out? We simply, if they have a debit balance, we credit the full amount to zero them out. It's got a credit balance, we zero those out with a debit balance. And so what we're doing is we're transferring them basically to retained earnings. And I know that one thing that's really interesting about textbooks is that that it may be sort of a lost art, but some companies will have a sort of pending or temporary account called income summary, where we sort of close things to that. And it's just sort of pending. It's a sort of a suspense item where it's open for a while, very short while. Doesn't do anything. There's nobody's really familiar with what it is outside the company, but it's just sort of a way to post debits and credits to that and close that to retained earnings. Okay. And by the way, companies are losing money. There's going to be a deduction from retained earnings, right? So it's not always the case that we're earning a profit and we're crediting retained earnings. Sometimes we're debiting retained earnings. We're losing money. And so obviously not a great situation, but it does happen. And we'd be remiss if we did not discuss the fact that sometimes companies lose money and sometimes lose money year after year after year. And that's kind of a thing. And we have to be aware that these things can happen. So the closing process is to zero these accounts out. Why? Why are we zeroing them out? Because we're going to start over again. And we've ended up at 1 year. Remember, the income statement, which translates or which communicates revenue and expense and all the other inflows and outflows will end. That period will end. So we're going to close that period out and we do it in a formal process called the closing process. Well, let's talk about what's going on. So number one, we're going to reduce temporary accounts to zero, and we're going to transfer those ultimately to retained earnings, whether it's positive or negative. So in this example, we got a number of different examples here in the text. And so we have assumed the fiscal year is for dress right is July 31st. Why they picked that, we don't know. Doesn't really matter, but nonetheless, we're going to do this. Sales revenue, which tends to be a credit balance account, is going to be closed. Now remember, revenue is a credit balance account. Every time you book something in revenue, it's going to go into credit. Well, here we're going to debit it because we're going to reverse it. Why? Because we're going to zero it out. So we're going to zero out sales revenue. Also the same with the rent revenue. Well, all revenue or all inflows really are credit balance accounts when it comes to the income statement. So we're going to reverse those and post debits, okay? And then we're going to credit retained earnings. And why wouldn't we, right? Because we'll close these guys out. These are inflows of remember, if you think about inflows of assets, whether it's cash or receivables. And so as a result, we're going to reverse those and close them by dumping those into retained earnings. Or if you like the intermediate step, income summary, where we do one sort of pending amount. But your text, I think, sort of alludes to it. I know when I first started teaching accounting, we started using income summary. It's just a way of having a temporary measure by which we sort of captured operating activities and sort of dumped them into it. Okay. All right. So that's the revenue side. What about the expense side? So here we have a number of different things. And so let's go back here, and I want to talk about where these numbers come from, so that there's no confusion over what. Let's go back to 82 in the slide package. And so remember, let's just think where we came from here. We had, we're closing out 38,750. That's 38,500 in sales revenue. That's sales of whatever it is we're selling here, right? And then rent revenue of 250. And where those numbers come from, they go back to some of the earlier numbers here, where it's on the income statement itself, right? Sales revenue 38,500, and then we come down here, we have rent revenue, which is all the way at the bottom because why? It's a non-operating activity. We're not in the business of renting stuff, but we have rent revenue coming in, right? Our business is making dresses or clothing, or whatever it is. And so it's not really here, it's down lower because it's not part of the normal activity we're doing. But nonetheless, it is an influence. So as a result, we're going to zero these guys out. Okay, both those two. And then if we come back to the financial, oops, went too far. We have expenses now. So we have, first of all, cost of goods sold, salaries, supplies, rent expense, depreciation, interest expense. Where those come from? They came from the balance of the income statement. So now remember, we're going to do the income statement first, right? The operating statements come first, and so as a result, what are the big expense items? Well, certainly cost of goods sold, and I can't think of too many companies where cost of goods sold is not the major expense. Although, you know, if it's a service business, you might have things like salaries that are bigger. If it's manufacturing or merchandising, certainly merchandising or wholesale and retailing, cost of goods sold is going to be a big number. But it doesn't matter how big they're expenses. So cost of goods sold, which we would usually put in a bracket here, and salaries, supplies, rent, depreciation, all those. And also interest expense, which is, again, a non-operating item. We're not in the business of generating interest expense, but it happens. And so as a result, those are expenses. And those are accounts that need to be closed as we get down here. And so as a result, all these figures, and we're going to simply do a debit to these credit balances account. Okay? All these are going to be, we're going to sort of debit these out. So, and we're going to debit retained earnings. Now, remember, they start with their expenses. And so these are debit balances accounts to begin with, right? Remember, on the equities side of the balance sheet, of the sort of chart of accounts, expenses are going to be a debit balance account. Cost of goods sold, salaries, are debit balance accounts. So how do we reduce them to zero? We zero them out by crediting the exact amount. And then what is the offsetting transaction that balances all these credits? It's one debit to retained earnings, okay? Or the income summary, and then we credit that and debit retained earnings. It's just another step in the line. But I don't really mean to complicate this, but rather to sort of suggest that what we're trying to do here with income statement accounts is to close them out. And why are we closing them out? We're closing them out so we can start again. And so we zero them out. Asset, balance sheet, asset, liability, shareholders' equity accounts really don't get closed. I mean, retained earnings is oftentimes adjusted for dividends and whatnot, but dividends are, they're sort of an optional item. Some companies don't pay dividends at all, ever, right? And so dividends are not really an issue, but operating items like these are going to get closed, okay? And then what is the effect on retained earnings? Okay, so retained earnings, we had two different, we had a debit and credit both being dropped into the, so we had, in this case, 38,750 as a credit, and 35,833 is a debit. And so as a result, what is the bottom line here is the credits outweigh the debits, and so we have a net income figure, and that is the net income figure. And if right now, forget about tax, right? In the real world, we worry a lot about tax, but here we're not. All we're simply doing is taking credits minus debits, or vice versa. If it's vice versa, we're going to have a debit. That's going to be a loss, right? In this case, we have a net income figure. So 2009-17. And by the way, that matches up with the income statement we covered earlier, which has a net income of 2009-17. Again, let's not get hung up with the fact these are tiny numbers. And we tend to be talking about public companies, but nonetheless, that is, if you want to slap 6 zeros onto that and makes you feel better, you can do that. But nonetheless, the idea is we're trying to reconcile the income statement back to retained earnings. And again, we talk a lot in intermediate accounting, an awful lot, because it's important about the what we call articulation, that one statement feeds into another, they fold together, and they have to balance. And if they don't balance, we have to kind of figure out what is happening. And that's a lot of what the job of accounts is trying to figure out where these discrepancies may lie, right? But for the most part, though, they will balance, and any kind of balance sheet, income statement presentation, and other statements as well. This should be there. This reconciliation ought to be there. If it's not there, then we've got a serious problem. Okay. All right. So that's what's going on here. So with regard, so the balance in retained earnings is net income. Okay. And this is what we call capitalizing earnings. We haven't expensed these away. We haven't paid bonuses to executives. We haven't, paid taxes. Well, we're assuming this is after tax. I know it's not explicit here, but this is the amount that gets what we call capitalized. By capitalized, I simply mean we're putting it into the capital structure of the firm, and then as retained earnings. And there are a lot of companies that have operated for a very long time that just simply really don't pay things out to workers and dividend out. They're making a tremendous amount of money. I think about the tech space here in particular, where retained earnings just go up and up and up and up and up. Now, there are some particular tax issues about doing that, and that's sort of my bailiwick. We're not going to get into here. But nonetheless, from the accounting perspective, how we record debits and credits, how we close accounts out, this is really the methodology. Okay. All right, so questions about what we're doing with respect to retained earnings and taking earnings and crediting them to retained earnings, which is the shareholders' equity account. All right, so I'm running a little bit low on time here, maybe about 4 minutes, and we're going to close dividends and retained earnings. So dividends are kind of an odd animal. They are simply distributions of equity back to owners. And I think I've talked about this before in this class, where I think to the extent that the passive investor is thinking about dividends, they want to sort of correlate it with earnings and whatnot. And sometimes that's a rational, reasonable expectation, sometimes not. Sometimes companies have giant earnings and pay no dividends. Sometimes companies have negative earnings and pay huge dividends. I'm thinking of the oil companies here. And so it really comes down to dividend policy. But our interest here is not over these more wide-ranging sort of concerns. It's more about what is the effect on the balance sheet with dividends. And dividends are simply a reduction in retained earnings, right? We're reducing retained earnings, we're going to create dividends, right? And the dividends usually are declared by the board of directors, and They're payable at some point down the road, 2 or 3 weeks, whatever the case might be. And a lot of investors expect to get dividends on a fairly routine basis, and so they sort of follow dividend policy. And dividend policy in itself is really an interesting subject because a lot of companies have different views on the matter. There are some companies whose stocks are considered quote unquote dividend stocks. Others not so much. And so dividends are, but all they really are from the accounting standpoint, a pure accounting standpoint, is simply a distribution of equity back to shareholders. Whether it matches the earnings that correlate with the time period is a little bit more variable, and so it's hard for us to give a definitive answer on that. Okay, and one final thing here, is we're almost out of time, is we do a post-closing trial balance. After all the adjusting entries, we're going to make sure that debits equal credits, and so as a result, we have a year-end balance that matches that up. Okay, and that's really what it is. And so from there, I think it's a good stopping point. Plus, we're out of time anyway. But I'll try to come back and record the rest of this. And I really apologize. I've been doing this for a while. This is not my first day, and we've had all kinds of problems with Zoom and all that in this room. But I'll try to pick up a separate piece of this particular chapter 2, so we can wrap it up. I want to come back on Thursday. I don't want to cover chapter 2 anymore. I want to get in chapter 3. I want to do that on Thursday. So I will pick up this and post a separate video so that you can kind of wrap this up. We don't have much more to do here, but it's important that we kind of go through it. And I do like this sort of transaction entry methodology, which is sort of a teaching technique in intermediate accounting. Okay, so I'll do that and I'll post that. If you have any questions about anything whatsoever on what's going on, let me know. Send me an email, call me, stop by, whatever you want to do. Otherwise, I'll see you all on Thursday. Have a great rest of your day.